What if a small financial mistake today quietly lowers your credit score and costs you thousands of dollars tomorrow? Most people check their credit score once in a while. They see a 3-digit number. Sometimes it goes up, sometimes it drops. But very few people truly understand what is happening behind the scenes. That number can decide whether you get approved for a loan. It can affect your car loan, your credit card approval, and even your rental application. So how is this number actually calculated? Is it random? Is it a secret? Or is there a clear system behind it? Today, we are going to break it down in simple words. By the end of this video, you will understand exactly how credit scores are built and what really controls that number. Let's begin. What a credit score really is. A credit score is a number, usually between 300 and 850. This number tells lenders how risky it might be to lend you money. The higher your score, the safer you appear. The lower your score, the more cautious lenders become. It is important to know that your credit score does not directly measure your income or how much money you earn. Instead, it measures how you manage borrowed money. It reflects your habits over time. Banks, landlords, insurance companies, and other lenders use this number as a quick way to judge financial responsibility. For most people, scores fall in the good range or above, and the average score in the United States is around the low 700s. But that number is not fixed. It changes depending on your financial behavior. And it all starts with something called your credit report. It all begins with your credit report. Behind every credit score is a credit report. Think of it as your financial record. It includes details about your credit cards, loans, payment history, balances, and applications for new credit. 3 major credit bureaus collect this information: Equifax, Experian, and TransUnion. Each one gathers data from lenders and stores it in its own system. Because they may not collect identical information, your score can be slightly different depending on which bureau's data is used. Once the information is collected, a scoring model analyzes it. There is no single universal formula, but the most widely used scoring system follows a general structure with clear weight percentages. Let's break that down. Payment history, 35%. The biggest part of your credit score comes from your payment history. This section makes up about 35% of the total score. That means it carries more weight than anything else. Lenders want to know if you pay your bills on time. Every time you make a payment before the due date, it sends a positive signal. If you miss a payment, it sends a -1. Even one late payment can lower your score. The longer a payment stays unpaid, the more damage it can cause. A payment that is 30 days late hurts your score, but one that is 60 or 90 days late can hurt even more. The good news is that consistent on-time payments build strong credit over time. You do not need to pay extra to benefit from this category. You simply need to pay at least a minimum amount by the due date. Steady behavior builds trust in the system. Amounts owed, 30%. The second largest factor makes up about 30% of your score. This part looks at how much you owe compared to how much credit you have available. This is often called credit utilization. For example, if your credit card limit is $1,000 and you owe $300, you are using 30% of your available credit. Lenders generally prefer that you use less than 30% of your total limit. Lower usage usually looks better. High balances can lower your score, even if you pay on time. This happens because using a large percentage of your credit limit may suggest financial stress. On the other hand, keeping balances low shows control and discipline. Even paying down your balance before your statement closes can help reduce the amount that gets reported, which may positively affect your score. Length of credit history, 15%. About 15% of your credit score is based on the length of your credit history. This part looks at how long your accounts have been open. The scoring system considers the age of your oldest account, your newest account, and the average age of all your accounts combined. A longer credit history usually improves your score because it shows stability and experience. This is why closing old credit cards can sometimes hurt your score. When you close an account, you may reduce your overall credit history length and lower your total available credit. That can increase your utilization percentage and slightly lower your score. Keeping older accounts open, even if you use them occasionally for small purchases, can help maintain a stronger credit profile over time. Credit mix, 10%. Another 10% of your score comes from your credit mix. This refers to the different types of credit accounts you manage. There are generally two main types of credit. One is revolving credit, like credit cards, where the balance can change each month. The other is installment credit, like car loans or mortgages, where you make fixed payments over time. Managing different types of credit responsibly can show lenders that you are capable of handling various financial obligations at once. However, this factor carries less weight than payment history or amounts owed. It is not necessary to open new accounts just to improve this category. It tends to improve naturally as your financial life grows. New credit inquiries, 10%. The final 10% of your score is based on new credit inquiries. When you apply for a loan or credit card, the lender checks your credit report. This is called a hard inquiry. A few inquiries over time are normal and usually have a small impact. However, applying for several new accounts in a short period can lower your score slightly. Multiple applications may suggest to lenders that you are facing financial pressure. It is important to know that checking your own credit score does not harm it. That type of check is called a soft inquiry and does not affect your number. Being mindful about when and how often you apply for new credit can help protect this part of your score. Why scores can be different. You may notice that your credit score is not exactly the same everywhere you check it. One app might show one number, while another service shows something slightly different. This happens because different credit bureaus may have slightly different information. Also, some lenders use different scoring models depending on the type of loan. These differences are normal. Instead of focusing on small variations, pay attention to the overall range and direction of your score. Why your score changes over time. Your credit score is not permanent. It updates as new information is added to your credit report. If you pay down debt, your score may increase. If you miss a payment, your score may decrease. If you open a new account, your average credit age changes. Because updates happen regularly, your score can move month to month. Small habits, repeated consistently, shape your long-term results. Why understanding this system matters. Your credit score affects many parts of your financial life. A higher score can mean lower interest rates. Lower interest rates can save you thousands of dollars over time. For example, even a small difference in mortgage interest can add up to significant savings across many years. That is why understanding how your score works is so important. When you understand the 5 main categories and their weight percentages, the system becomes predictable. 35% payment history, 30% amounts owed, 15% length of history, 10% credit mix, 10% new inquiries. Once you know these numbers, you can focus on what matters most. Pay on time, keep balances low, be patient, avoid unnecessary applications. The system is not random. It rewards consistency and responsible behavior. Your credit score may look like just a simple 3-digit number, but behind the scenes, it is carefully calculated using clear categories and percentages. Payment history carries the most weight. Debt levels follow closely behind. The age of your accounts, the mix of credit you manage, and how often you apply for new credit all play a role. When you understand how the system works, you stop guessing. You start making smarter decisions. Over time, small disciplined habits can build a strong financial reputation. If this video helped you understand how credit scores are actually calculated behind the scenes, like this video, share it with someone who needs this information, and subscribe to the channel for more clear and practical financial content.